Good morning. Today we are initiating coverage on the electronic design automation, or EDA, sector. As we analyze the fundamental drivers of the semiconductor supercycle, it becomes evident that chip design software is the critical bottleneck and primary enabler of the AI hardware boom. We are looking at a deeply entrenched oligopoly, primarily dominated by Synopsys and Cadence design systems. These firms possess structural moats characterized by immense switching costs, extremely high barriers to entry, and mission-critical software ecosystems. Without EDA, the development of advanced sub-3 nanometer silicon and custom AI ASICs by hyperscalers simply halts. The sector represents a high-conviction derivative play on artificial intelligence, offering institutional investors insulated exposure to semiconductor secular growth without the capital-intensive cyclicality associated with semiconductor foundries. Our thesis posits that the escalating complexity of AI compute will drive sustained double-digit top-line growth and multiple expansion across the sector. Moving to market dynamics, the proliferation of generative AI and large language models has fundamentally altered silicon compute requirements. We are witnessing a massive paradigm shift as hyperscalers like Google, Amazon, and Meta pivot toward designing custom application-specific integrated circuits, or ASICs, to optimize AI workloads and reduce dependency on merchant silicon. This structural shift drastically increases EDA tool intensity. Designing a monolithic 3 nanometer or 2 nanometer chip involves billions of transistors, introducing exponential complexities in thermal management, power distribution, and signal routing. The semiconductor industry's transition from FinFET to gate-all-around transistor architectures, coupled with advanced 2.5D and 3D heterogeneous packaging, directly translates to expanded seat licenses and increased computational usage of EDA simulation software. Consequently, we project EDA utilization to scale non-linearly with Moore's law deceleration, acting as a structural tailwind for the sector. Looking at top-line trajectories, the core EDA addressable market is currently valued at approximately $15 billion, but our quantitative models project a robust compound annual growth rate, or CAGR, of 12% through 2030. More importantly, the AI-driven system design and simulation subsegment is compounding at an accelerated rate of over 20% annually. This TAM expansion is underwritten by escalating R&D expenditures across the semiconductor complex. Even when semiconductor capex undergoes cyclical contractions, R&D spend remains remarkably resilient, shielding EDA revenue streams from the underlying semi-down cycles. Furthermore, we are modeling a 150 basis point annual expansion in operating margins over the next 3 fiscal years. As the product mix shifts increasingly towards cloud-based software as a service and upfront IP licensing, the ratable revenue recognition models provide exceptional forward visibility, making these assets highly attractive to fundamental long-only funds. Analyzing the competitive landscape, the EDA sector represents a textbook duopoly with high Herfindahl-Hirschman index concentration metrics. Synopsys and Cadence design systems collectively control nearly 70% of the pure-play EDA market, with Siemens EDA capturing the bulk of the remainder following its acquisition of Mentor Graphics. The barriers to entry here are virtually insurmountable for new entrants. The existing software suites possess millions of lines of highly optimized proprietary code, validated over decades by fabs like TSMC, Samsung, and Intel. Furthermore, the switching costs for an engineering team to migrate from Cadence's Virtuoso or Synopsys's Fusion compiler to a rival platform are prohibitively high, often resulting in massive delays in tape-out schedules. This lock-in effect grants SNPS and CDNS immense pricing power, allowing them to consistently pass on mid-single-digit price hikes annually without observing any material churn in their customer base. From a fundamental accounting perspective, the business model transition over the past 5 years has been a masterclass in value creation. Both primary players have successfully migrated their legacy perpetual license models to highly predictable, ratable subscription revenue frameworks. This shift has fundamentally structurally enhanced their balance sheets, generating massive deferred revenue balances that fund ongoing operations and robust share repurchase programs. When we analyze the unlevered free cash flow profiles, we see cash conversion cycles operating at peak efficiency. Gross margins consistently hover in the mid to high 80% range, while non-GAAP operating margins have scaled from the high 20s to the high 30s and low 40s. The operating leverage inherent in this software model means that incremental dollar growth in AI-driven TAM flows almost directly to the bottom line, driving aggressive EPS growth that outpaces top-line revenue expansion. Addressing valuation multiples, we acknowledge that the EDA sector screens expensively on a traditional basis, which often deters value-oriented portfolio managers. Synopsys and Cadence typically trade between 35 and 45 times next 12 months, or NTM, consensus EPS, and command enterprise value to EBITDA multiples in the 25 to 35 times range. However, we argue this premium is entirely justified. When adjusting for growth using the PEG ratio, the multiples become much more digestible. The valuation premium reflects the sector's zero-beta characteristics relative to broader semiconductor cyclicality, pristine balance sheets with net cash or highly manageable debt profiles, and defensive moats. We prefer to value these equities utilizing a 10-year discounted cash flow model, assuming a weighted average cost of capital of roughly 8.5% and a terminal growth rate of 3.5%. Under these parameters, the current equity risk premium accurately prices in their monopolistic cash flows. Drilling down into Synopsys, ticker SNPS. Synopsys maintains a dominant market share in digital design flow and semiconductor intellectual property, or IP. Their IP portfolio is essentially a toll road for modern silicon, providing pre-designed blocks for standard interfaces like PCIe, USB, and DDR memory. This pre-verified IP dramatically accelerates time to market for chip designers and acts as a massive high-margin growth engine. Strategically, their pending acquisition of Ansys for $35 billion represents a monumental pivot towards comprehensive silicon-to-system design. By integrating Ansys's premier multi-physics simulation capabilities, covering thermal, structural, and electromagnetic analysis, Synopsys is positioning itself to capture the entire system-level TAM. While the M&A premium requires debt issuance that temporarily levers the balance sheet, our accretion dilution analysis indicates the deal will be significantly accretive to non-GAAP EPS by year 2, yielding substantial cross-selling synergies. Turning to Cadence Design Systems, ticker CDNS, Cadence holds the definitive industry standard in analog and mixed-signal design, heavily anchored by its Virtuoso platform. Under current executive leadership, Cadence has executed flawlessly, expanding beyond traditional EDA into structural system analysis and computational fluid dynamics. Their strategic allocation of R&D capital into AI-driven tools, such as the Cadence Cerebrus platform, utilizes reinforcement learning to automate the floor planning and routing processes. This drastically reduces the engineering hours required for complex chip tapeouts. From a financial metrics standpoint, Cadence has demonstrated phenomenal margin discipline. Their return on invested capital, or ROIC, consistently exceeds 25%, showcasing elite capital efficiency. We model their system design and analysis segment to grow at a 25% CAGR, acting as a massive margin accretive catalyst that will support further multiple expansion over the next 24 months. As prudent risk managers, we must construct a rigorous bear case. The primary structural risks to the EDA thesis are geopolitical and macrocyclical. The United States government's ongoing export controls and entity list restrictions actively prohibit the sale of sub-14 nanometer EDA tools to Chinese semiconductor firms. While China historically represented roughly 15% of total EDA revenues, the immediate loss of leading-edge licensing presents a top-line headwind. Secondly, the regulatory environment poses a risk to inorganic growth. Antitrust scrutiny could block or severely delay synergistic M&A, as seen with the rigorous review of the Synopsys-Ansys transaction. Lastly, from a quantitative valuation standpoint, the sector is highly sensitive to the risk-free rate. A higher-for-longer yield curve scenario would mechanically compress long-duration software multiples, potentially leading to a 15 to 20% multiple contraction, even if fundamental earnings estimates remain completely intact. In conclusion, our bull case thesis establishes EDA as the ultimate picks and shovels play for the artificial intelligence gold rush. As hyperscalers and semiconductor pure plays deploy hundreds of billions in capital expenditures to build out AI infrastructure, a mandatory fraction of that spend must flow through the EDA oligopoly to design the next generation of silicon. We foresee upward revisions in consensus EPS estimates as AI-driven automation tools command premium licensing fees. Our base case price targets imply a 20% upside from current trading levels, underpinned by durable 15% EPS compounding and robust free cash flow generation. For institutional portfolios seeking high-quality growth with deep defensive moats, we rate both Synopsys and Cadence as overweight. The structural realities of Moore's Law and advanced packaging dictate that chip design complexity will only increase, securing the EDA sector's trajectory for the next decade.